You should watch this video until the end. I'm gonna cover 3 indicators on TradingView that helps you to know when the smart money is entering into the market. The third one is the best of them, so make sure you watch this video until the end. Let's begin with the first one, which is negative volume index. We add this one, which is written by H. Potter. This is one of the most basic indicators that is designed for tracking smart money. It's actually a cumulative indicator that uses changes in volume to decide when the smart money is active and entering into the market. This indicator assumes that the smart money is active in time periods when volume decreases, and not so smart money, which is the money from retail traders, is active in time periods when volume increases. The red line is MVI line, negative volume index line, and the blue line is a 255 period exponential moving average of the MVI line. Based on the research of Norman Fosbach, who created this indicator, there is a 96% chance of a bull market when MVI line is above its moving average line, but on the other hand, there is only 53% chance of a bear market when MVI line is below its moving average line. So when using this indicator, better to focus on bullish crossovers, which is when MVI crosses above its 255 EMA. But this signal alone is not enough for us to take a trading decision, because these crossovers are prone to be false signals and we need to filter the false signals. One excellent matching indicator is RSI, this one, Relative Strength Index, which by the help of this indicator, you can easily filter the false signals. As I explained earlier, with this indicator, we only focus on bullish crossovers, which is when the MVI line crosses above the moving average line, because based on the research, it provides more probability in comparison to the bearish crossovers. So when the red line crosses above the moving average line, here in RSI, the RSI line should be above the center line, but not above 80. We don't want to enter a trade in overbought condition. So for example, this bullish crossover here is rejected because RSI line is not above the center line, but this bullish crossover here is accepted because RSI is above the center line and it is not overbought. And you can see that the RSI line is between 50 and 80. So in practice, we could enter a long position at this point, and you can see how the price advanced sharply after the signal. This is exactly the type of market condition when institutional and large traders enter the market. When the market is very calm in tight consolidation period, they start opening very large positions, and around here is actually where retail traders enter the market, especially around here where the market is already overbought. This bullish crossover here is not accepted because RSI is showing overbought, so the signal here is rejected. The next indicator is L3 Banker Fund Flow Trend Oscillator, this one, which is written by Black Cat 1402. As the name is indicating, this indicator shows flow of funds from banks and large institutional traders. These large funds can have different names depending on the market. For example, in Forex market, they are usually called bankers fund because banks are the big players in Forex market. Generally, it is called smart money. Regardless of the name, we want to know when those large amounts of money are flowing into the market because we know that it can move the market significantly, and this indicator helps us with this. As I mentioned for the previous indicator, bankers and large institutional traders enter in the market when the market is calm, especially when the market is flat and we have low volatility in the market. They don't enter in the market when everyone is buying and the price is advancing sharply. Actually, they exit their positions when we have this condition of the market. So they usually enter in the market when the market is flat with very low volatility, and their large positions create movement of the market, and when retail traders start buying and further moving the market, the bankers start reducing and exiting their positions when the price is in their targets. And again, because their position sizes are very large, this causes declining of the price and creating a peak on the chart. In this indicator, when we have a yellow candle, it shows that probably the bankers fund is flowing in the market. In other words, the smart money is entering into the market, but we focus to the yellow candles that form in low volatility condition. So having a volatility indicator like Bollinger Bands or Keltner channels can effectively help you on this, because we take the signals that happen during low volatility period. When we have green candles, it shows that bankers are increasing their positions gradually. This is also a period when retail traders are entering in the market, and bankers and institutional traders are getting ready to reduce or exit their positions. When we have white candles, it shows that bankers are decreasing their position sizes. Please pay attention that having a green candle like this again after the white candles doesn't necessarily mean that bankers are adding to their positions again, and this can be just reflection of what retail traders are doing. And when we have red candles, it shows that bankers are exiting their positions. So they started decreasing their position around here. We had a little bit more buying pressure, which is mainly by retail traders. And from here, bankers are exiting their positions. When we have a blue candle, it can show a probable and weak rebound of bankers. Tells us that probably they are entering again. This is especially true if we get green candles after them, which you can see that it didn't happen around here. But for example, from here, green candles are appearing and the market is extremely flat, as you can see. And this is exactly the ideal situation for smart money to enter. And from here, you can see that we got a very sharp advancing of the price. And after that, sharp declining, which is actually where the bankers are exiting their positions. And the next indicator is Concord, this one. Concord version 2, which is written by Marcos Emi. Alright, this is the indicator, and as you can see, it is in the form of an oscillator with some shapes and lines that are moving above and below the center line, which is 0. This indicator is built based on 4 trend indicators and 2 volume indicators, and actually the volume part of this indicator is the important part, which shows track of smart money flowing by large and institutional traders, and also track of not so smart money flowing by retail traders. The 2 volume indicators used in this indicator are positive volume index and negative volume index. Negative volume index is the first indicator that I introduced at the beginning of the video. Negative volume index is used to know what smart money is doing, and positive volume index is for tracking retail traders, and they are usually used together to analyze the market. And in this indicator, we have both of negative volume index and positive volume index with a perfect combination, so we can simultaneously analyze both of them at the same time. The green part of this indicator shows buying and selling activity of retail traders, and this light blue part shows the buying and selling activity of the strong hands in the market. In other words, it shows flowing of smart money from large and institutional traders, banks, hedge funds, and other large financial entities. The position of the blue part and green part regarding the center line can tell us if they are buying or selling. If above the center line, they are buying, and if below the center line, they are selling. The blue part and green part should be analyzed in conjunction with each other. Besides these 2 components of this indicator that perfectly helps us with analyzing volume and buying and selling pressure from different players in the market, we have also this brown part, which helps us with trend identification. It is built based on 4 trend indicators, and alongside with this red line, which is actually its moving average line and plays as a signal line here. Together, they can help us to discover advancing or declining of the price. When the brown part crosses above the moving average line, it shows advancing of the price, and when the brown part crosses below the moving average line, it shows declining of the price. These crossovers show short-term advancing or declining of the price, and because of this, they also show the pullbacks, or during range market, you may see some false crossover signals. I'm going to publish a very accurate trading strategy based on this indicator soon, so make sure you subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.